We can begin. So, good afternoon, and welcome to Gray Gray's update on new overtime regulations. I'm Frank McLaughlin, and I'm a manager in Gray Gray's McDonald's practice group. I cannot stress enough the impact this new overtime regulations are going to have on employers and employees across the country. They will affect hundreds of thousands of business owners and millions of employees. The new regulations are likely to have a particularly significant impact in the restaurant industry, including McDonald's. This is not something that is coming way down the road. The regulations take effect on December 1st of this year. We have just a few months to make preparations and adjustments to deal with regulations that were only finalized and announced just a few weeks ago. I want to stress before we begin that I am not a labor attorney and cannot address possible legal interpretations of the new law. But I am an accountant, and I can definitely speak to the effect the overtime rules will have on your payroll cost, how they will affect your business, and steps you can take to minimize that impact. So please know that today's webinar will offer you an accountant's perspective, and should you need legal advice, feel free to contact me. I'm happy to give you out some names of some of the attorneys we work with. That, in a nutshell, is what we'll cover today: how the overtime rules have changed, what the new rules might do to your payroll budget, and how to adjust and adapt your payroll strategy in the face of this new reality. So let's begin. So if you have any questions regarding your own personal company questions, please feel free to reach out to me. My number is 781-407-0300, or you can email me at fmclaughlin@graycps.com. So what are we going to cover today? Let's talk about the four things that we're going to cover. I'm going to talk about the current law. About the current law is so that you know what has changed and what has not changed. I'm going to talk about the upcoming changes to the law. I'm going to talk about how you can calculate the business impact of the law change. And then I'm going to do a business case that kind of uses that calculation of business impact, so you can kind of get some real numbers behind how this is going to impact you. Before I begin, I just want to talk about, I'm going to throw out the words not exempt and exempt, and just for clarity's sake, not exempt means that you have to pay someone overtime for anyone that works over 40 hours. Exempt means you do not have to pay someone overtime over 40 hours. So that's a really high level answer for non-exempt and exempt, but I wanted to just clarify that so when I talk in the future you kind of know where I'm coming from. So what's the current law? So the current law works, and how do you kind of determine whether or not someone is non-exempt or exempt? So there's three tests that we have to kind of look at to see if someone is exempt or non-exempt. The first part of that test is a salary basis requirement. That is pretty much you're paying someone a predetermined amount of money regardless of quality or quantity of work. I'm going to pay you $2,000 a month. It's salary. It's as easy as that. Then we have the second test, which is the salary level requirement. This is the biggest impact, and this is the change of the law, which I'll talk about in a second, but this is the piece that changes. Right now, you have to pay $455 per week, or which equals $23,660 a year. HCEs, I'll just get into it really quick, are highly compensated employees. Right now, that number is $100,000, and that if you pay someone over that, they're almost always exempt. So if you pay someone currently as it stands, you have to have the salary basis test, and then you have the salary level test. If you do not meet the salary level test, so if you only pay someone $20,000, they're automatically not exempt. They cannot be exempt if you pay them under that amount. So just know that when we talk in the future with the new increases, anyone under that amount is non-exempt. And then the third test and the final test is the duties test. Now, we're in the current law as it stands today, if you pay someone over $2,660, then if they pass these duties tests, then they can be exempt. All right? Just because we pay someone over the salary level test does not mean they are exempt. They still have to pass the duties test. The first duty I'm going to talk about, which is pretty easy, is professionals. These are lawyers, accountants, engineers. These are people that go to school or college to have a learned career. Doesn't really impact you, so we'll get that out of the way. The two that impact you are executive and administrative duties. Kind of what they are and what constitutes an executive or administrative duty. I want to talk about what, especially in the restaurant industry, what your general manager, director of operations, department managers need to be doing to be considered exempt. They have to be working more of their time, most of their time, on these exempt and administrative duties, right? So if you just look at it purely from a percentage standpoint, if they're working 51% of the time doing executive administrative duties, currently they would pass that duties test. The executive, so now we have to talk about what is executive and what is administrative. Administrative, I'll get over that. That's more of your directors of operation type people. They're working in your office. They're, overseeing your whole organization, and they have significant judgment on what your business is. They're making major decisions on your business. That's administrative. Don't think of administrative as, you have an administrative assistant that answers your phone. No, this is somebody that is very important and it makes very significant business decisions. The next is executive. Executives are people that run a subdivision or a division of your company, that hire, fire, train, and make decisions to run that division and subdivision. That kind of equates to your general managers, right? And they have to be doing that most of the time. Now, when I say subdivision or division of your company, if you have 5 restaurants, each one of those is considered a division. So those general managers are running that division of your business. Which, after all, I want to kind of talk real quick at a high level and kind of give you one of the takeaways that I want you to have today. These duty tests are important, right? Because once we get to the level test, then we have to prove these duty tests, which will become even more important with the new laws. So one of the things I would like or ask you all to do is look at your job descriptions. What are the job descriptions of your director of operations, your supervisors, your general manager, department managers? When's the last time these have been updated? Do you even have them? I would strongly suggest, if you have not looked at your job descriptions in quite a while, to look at them and to update them to make sure they're relevant and updated. If you don't have them, I think that it's worth the time to those job descriptions. Because one of the first things the DOL is going to do when they walk into an audit is they're going to ask for your job descriptions, and then make sure what those job descriptions are is what your people are actually doing. So making sure you have them helps with, defending your exemption point. So there are the 3 tests of the current law. We have the salary basis, the salary level, and then the duties tests. So what are the goals of the DOL? The goals of the DOL, and I had to read most of this law. It's 120 pages. It's pretty crazy. But one of the things is, in the summary version, they say to us, this is going to impact 4.2 million employees. It's going to cost employers somewhere about $250 million per year, and over about a 5 to 10 year span is going to transfer income from employers to employees in the tune of 1.1 and 1.2 billion dollars. These are big amounts of money, and why we want to try to see if we can mitigate some of that dollar expense. The top bullet there, salary to be tied to wage percentiles. This is important, and I'm going to talk about it in a little bit more detail in the next slide with the changes. But what the DOL is trying to do is they're trying to tie that salary level test that we talked about to the 40th percentile of wage earners, and then the highly compensated to the 90th percentile of wage earners. Just kind of have that in the back of your head, because when I talk about it in a second, I'll show you why that's important and how that plays into the new rules and law. So, about the current basis and the duties test, they do not change. The only change that we have is the salary level requirement, and this is a big change. we go from $455 per week to $913 per week. And we go from $26,660 a year to $47,476 a year. This is just north of 100% increase from the old rules. This is significant. And anything that we can do to of this significant increase is going to be important. I know I talked about highly compensated employees, but that went up from $100,000 to $134,004. So now, here's two differences from the old law. The old law was created back in 2004, and that $23,660 has been stagnant since that day. It hasn't adjusted. The new law adjusts every 3 years. And guess what it attaches itself to? It attaches itself to that 40th percentile of wage earners, right? So every 3 years, the DOL is going to do a recalculation and get it back to that 40th percentile, right? Now, it's important to know this because you need to make sure that you're keeping up with that 40th percentile of wage earners, because if you're not, on January 1st, 2020, we could be running into a new issue, right, where we have to figure out what the impact is going to be to get people up to that new 40th percentile wage. And then the last change is bonuses and incentive payments to satisfy 10%, no more than 10% of that $47,476, right? So this is new. You were never able to use bonuses and incentive payments to satisfy no more than 10%. I just want to make it clear this is non-discretionary bonuses. So these are bonuses that are, you put your general manager say you need to hit a food cost of X or a profit after controllable percentage of Y, and if you hit these amounts, you will get a certain percentage of dollar or a dollar amount. These are non-discretionary bonuses. These count. I want to talk about this for a second because I think it's important. One of the things that I want you to be cautious of is that this 10% is, yes, you're able to use these 10% to get you over the threshold of $47,000. And just for future, so I don't have to say $47,476, $47,500. A little bit easier to say and digest, I guess. So what can happen is, and by the way, you have to pay these bonuses at least on a quarterly basis, so you at least have to pay them 4 times a year. But what could happen is after the first 3 quarters, you've paid the amount of money that you want to pay, and then you need and have to rely on that 4th quarter where that person needs to get that bonus to get over the $47,500, and you could, if they don't meet those standards, you could find yourself into a little bit of a trap, because you can't just say, oh, I'm just going to give them the $1,000. That's a discretionary bonus, and as the law states right now, and now this is a new part of the law, so we don't know how it's going to play out, but it could be a trap because you may not be able to get them over that $47,500 amount. So just bonus, it's a nice little piece, but make sure that you've given yourself some cushion in case the metrics aren't met for whatever reason. So now, how do we... So I just got a question. Does Christmas or end of the year bonus count? So it really goes back to, is it discretionary or non-discretionary bonus? If you are just giving them based on no real basis on how you're giving the numbers, it would not count. But if you have a year-end bonus because they hit certain metrics throughout the year, and and you put a percentage and a dollar amount to those, that would count. So maybe you can play with it where if someone meets, and I'm just using the quarterly example right now, I'm just going a little off topic right now, so I apologize, but maybe you put in there that if they meet 3 out of the 4 quarters, I'll give them a year-end bonus. But something that you kind of have to be a little just make sure you're on top of it and you know what you're doing, and and getting over that $47,500. I hope I made myself clear on that. So then I got another question. How about quarterly incentive bonuses? So if those quarterly incentive bonuses, their incentives, are they hitting certain metrics, right? Are you telling them over the quarter you have to meet food cost at 27, 28% every month, and if they hit that, they're making their, then you've pretty much said to them, I'm going to pay you a bonus. If that's the case, that would count. So let's talk about, I hope we're all good there. It's really kind of, if you have a situation, a standard in place of paying an employee, that would count. If it's just something that you're just giving to your employee as a, hey, thanks for working here, this is new, right? So you don't really know how it's going to play out, but that's how the law states it today. And I would love to talk to you guys about it a little bit further, maybe offline after I talk about it. Okay. So I have one more question, then I'm going to hold off on the questions on bonuses just because I want to be able to move along. And the question is, if you have a program where they can earn over by earning a bonus of $47,500 and you have a poor performer and they do not get the bonus, then what is your liability? Your liability is that you could have to go back, recalculate their hourly earnings, and pay them for the overtime that they were not paid. So like I said, it's a little bit of a trap that you have to be aware of, because it could cost you extra money if those things do not fall in line the way you think you should. So let's go on to how we calculate it. It's a pretty simple calculation. It's math, and I want to talk about, before I get into my calculation of business impact, all of my examples are really simplified. We're talking about bonuses and all these other things, and some of the other things that we can do is back into some of these numbers. So I just want you to be aware that I've oversimplified this just for simplistic sake, but if you ever want to kind of talk to me about some more in-depth kind of calculations and what are some of the other things we can do, then I'd be happy to talk to you about them. So step one, how many employees do I have that are salaried? Is it 5? Is it 10? Is it 15? Whatnot. Step two, do these employees already make more than the $47,500 a year? If they make more than $47,500 a year, we can remove them from our business impact calculation. But I don't want to remove, and I'll talk about this on kind of step 4, but we should absolutely, I think, still take them into consideration. I'll talk about that in a little bit. And if anyone is making under the $47,500, right, we have to move to step 3. We have to do some homework. We're going to have to do some calculation. So how do we calculate the cost? So we have to find, the first part is we have to find the average amount of hours over 40 hours that employee works. So if they work 45 hours, then hours and more than that amount, we're going to have to figure out those 5 hours and what that's going to cost me. Then we have to find the hourly rate of the employee. So let's just say they make $20 an hour. We're going to multiply that by 1.5, so they're making $30 an hour. Then we're going to multiply that average amount over, so that 5 hours over overtime, right? And then overtime rate of $30. So it could cost you, in this very simplistic conversation, $150 a week, right? And then if you extrapolate that out, it could be even more. So you're going to have to extrapolate that out by 50 weeks because that time I'm in there. And then you're going to add that base salary that we're talking about with our new calculated overtime salary, and add them together to come out with what that person's new salary is. Right? So we're good there. So that's kind of how what is this? And then we have to make a decision. If the amount of money that they're going to make is over the $47,500, should we just give them the raise to get over? Is that going to actually cost us less money that we don't have to worry about overtime? Or what other kind of considerations do we have to make, which is step 4? Do we shift around and maybe hire some more employees that we offset so that person is not working overtime? Or, do we work it so, we backdoor it, right? So you can backdoor it, and I'll talk about that in a second when we go through our real impact. And then the last type of thing is in that other consideration. So I was talking about what do we do with those people that make over $47,500? And this is me playing, fictitiously, but for a second, let's think and say, all right, I have a 10-store owner-operator. Two of my general managers have been with me for a long time. They have the most experience. They make over $47,500. Now I'm giving a raise to pretty much everyone else below them. Is that causing compression in my business? And how does that look? How does that feel to your most experienced employees that you have? So kind of take those other things into consideration as well as so you may have a salary person where you say, you know what, I don't want to pay them salary, I want to work them down to hourly. How does that feel? What is is that demoralizing to that person? Is that eroding the story of making McDonald's a career, right? So all of these other kind of considerations have to be thought about. And then the fifth one, we make the decision. What are we going to do with those people right near $47,500? What are we going to do with those lower paid people? And what do we do with anyone making over the amount? So I have another question. Do you have any recommendation on compression between our new salary versus our long-term GM but are below $47,500? Yeah, I would like to take that question offline if we could. I think that it really pertains to your organization, your location of your business. What are some competitors around you? What does that look like, and how's it going to look for what you want your organization to be, and how do you want that to look? So where are we, right? We have to make a decision. Any decision is going to cost us some money, and we have to figure out how to mitigate those costs. But we have to think about our human capital. We have to think about our people. We have to think about how we can, mitigate some of those other factors that we're talking about when it comes to compression or the story that we want to tell for this process. So here's kind of the scenario that I've kind of laid out, right? And I've kind of polled a lot of people throughout the country on this, and I've gotten like a 50-50, 60-40 that people have either multiple salaried employees in the restaurant or just one salaried employee. So I know this scenario is going to have two salaried employees, but I want to talk, and I'll kind of break it down how, if you only have one, how you can look at it. So we're going to be a 5-store restaurateur. We're going to have 2 salaried employees per restaurant, 1 general manager, 1 department manager. The general manager making $45,000 a year, and the department manager making $35,000 a year. And all of my employees work on average 45 hours a week. So we have to figure out what we're going to do with that 5 hours of overtime. For the people that only have 1 salaried employee per restaurant, I'm assuming that's your general manager. Think of the scenario as you have more experienced, more experienced general managers that are making that $45,000, a little closer to that realm, and then you have less experienced new general managers or Walmart general managers, Stowe general managers making that $35,000. So you can kind of play it both ways and kind of get an idea for what that looks like. So what are we going to do? We're going to go right through the steps that we said we were going to before. We're going to, how many salaried employees? We have 10. Step 2, how many make over $47,500? We don't have any in this scenario, but if you, like we talked about, let's not forget them. Maybe there's something that we may want to do so that the compression does not happen. Right? And then we have 10 employees that make less than $47,000. We have the 5 that make $45,000, and we have 5 that make $35,000. So if you have 5 restaurants that only have 1 salaried manager, think of you have 2 highly trained, experienced managers making $45,000 and 3 that make $35,000. Hope I'm not moving too fast. I'm just trying to kind of work it for both scenarios. So now that we have to move forward to step 3 and calculate those costs, right? So we've figured out that on average, the 10 employees work 45 hours per week. The second thing is, how do we come with our hourly overtime rate? All right, so we have to work backwards. So if their salary is $45,000, we're going to divide that by the 52 weeks in a year, right? So we're going to get $865 a week that we're paying them. We're going to divide that by 40 hours in that week to come with $21.63 an hour. You're going to multiply that by the 1.5 times, and you're going to get $32.45. Again, I'm oversimplifying the kind of, because there are different ways to calculate the hourly rate of an employee, but for this example, kind of really basic, really straightforward. And then for those lower experienced general managers or your department managers making $35,000, we're going to divide that by 52 to get $673 a week. We're going to divide that by 40 to get $16.83 an hour. And we're going to multiply that by 1.5 times to get $25.25. So how does this all add up, right? Take that overtime and multiply that by 5. So we're going to take that $32.45 for our higher experienced general manager and multiply that by 5. So that's going to cost us somewhere in the vicinity of $162.25 a week. And again, I did that by 50 weeks with some vacations, so it's going to cost somewhere a little over $8,000. Now, let me just stop right there, because there's one thing I'm not taking into account and consideration. It's because it's variable for every organization, and that is your payroll taxes, your fringe benefits. What are those other benefits that you are giving to your employees? You know, is it 401k plan? What's that insurance look like? How many people are taking insurance? You understand, but that could be 15 to 20% of additional to the cost that I'm talking about in this webinar. For the lower paid general manager, you know, we have $25.25 an hour. We're going to multiply that, so that's going to cost me about $126 a week. Again, multiply by 50. That's going to give me a little over $6,000. Come up with that cost. So we're going to take their base salary, we're going to multiply it. Now remember, I'm just doing this as if we don't do anything, if we just leave everything the way we are, this is the impact that it could have on you. We're going to add the 45 to the $8,000, and you're going to get $53,000. That is $5,600 over the salary cap. So we're over our $47,500 salary level test that we have to meet. Now for the lower level employees, right, we're going to add $35,000 plus the $6,000 in overtime. We're going to get $41,000. We're still way under the salary cap, but this is an issue, right? Because in theory, that person is getting somewhere around an 18% increase in their salary. So something we have to kind of think about, what are some of the things that we can do? All right, so pretty straightforward. I think that the general manager making, you know, the $45,000, if they're working 45 hours a week, you're going to give them the raise. It's only going to cost you $2,500, way less, or $5,600, $5,500 less than paying them the overtime. So, you know, in my scenario, it's going to cost me $2,500 a store times 5 for a total of $12,500. If you're somebody who just has a couple general managers, right, that are making close to that, it's going to cost you $2,500 a store. Now, if they make 47, it could cost you $3,000, $4,000, but you know, it's going to be much less than that impact of that the $8,000 of overtime that you would have to pay them. The issue here, and I think this is some of your questions, is what do I do with my lower paid general managers or department managers, and you know, they're getting that 18% raise. What am I going to do there? So we have a couple options. Option one is the least desirable. It's just saying, you know what, we're going to give them the 40, pay them the overtime. That's going to cost me that $63. So if you multiply that by 5 restaurants, you know, you're talking $31,000. But, and for the other people in the audience that only have one, you're talking $6,000 a restaurant. So, so you can see how this can add up pretty quickly. The second thing that we can do is we can supplement those 5 hours with a lower level employee. Now, if you're having a department manager or a general manager do something, you're not going to have the same efficiencies of that person doing that work. So, if it takes them 5 hours, it may take someone 6 hours. I'm just using $10, again, simplified. So that could cost you $60 a week, 52 weeks, that's $3,000 a restaurant. So, we almost cut that in half by doing what we wanted to do there. We cut it in half by saying, you know what, let's add an employee to the level and try to work those hours and adjust those hours so that those hours can be worked by a lower level employee. Then we have the third option. And that third option is removing them from salary and backdooring the amount and doing a backwards calculation where, in theory, what you can do is come up with, if they work 45 hours, I know it's going to cost me X amount in hourly wages, it's going to cost me X amount in overtime wages, where you can kind of backdoor it and get you back to, right? Get you back to the exact salary they're making now. So it can almost, cost you almost close to zero if you kind of backdoor it. Now, I don't know if that's my suggestion because, again, I talk about those other considerations and talking about what does that look like when you take someone who's salary and move them to hourly. But it is a suggestion. It's an option, not a suggestion, option, sorry. So the total cost for the 5 restaurants, at the high level, you're talking about $2,500 to $6,300. So you're talking $8,000, $9,000 without payroll and fringe benefit expense. So you could talk about that $10,000 range. Or you could talk in that $5,000 range. But for the people that only have one general manager that's salaried, and you're pretty good with all your other overtime, you're talking you could talk $2,500 a restaurant, or you may, depending on what you've done, maybe zero. So it's really, that's why it's so important for you to kind of get ahead of this and calculate how this is going to impact your business, because everyone is going to be different. So what are those other considerations, right? Other considerations, how are we going to make up the hours? Are we going to adjust them? Are we going to just have the people work overtime? What are we going to do? We're going to hire that extra employee. What does this conversation look like? How can you spin this to be a positive for your organization, right? We talked about we're going to have to give some people raises so they're over $47,500. But I would hate for owner-operators to give raises and, not have a good story to tell with what you're trying to get across and not make it just, the law said you have to get paid more, so you get paid more. No, this is about, you're a good employee. How do we spin this to make it look good for the employee and make them feel good about who they are, instead of just, here, I have to give you this because it's the law. And then the other consideration is compression. What do we do with the people, that make over that amount, the $47,500? What do we, I think we all kind of make it pretty easy. Anyone close to that, we're going to give them the raise. But the people that are way below that are going to be getting a significant bump if we don't do a good job of, working through the hours. How do you deal with that compression where, the gap used to be 10,000, now it's only 3,000 or 4,000? How do you deal with that in a management meeting when people know what they're kind of, people talk nowadays and what they're doing. So how do you deal with that kind of situation? And that's if I make a decision. So I have a bunch of questions here, but before I kind of grab at some of those other questions, I want to just kind of say what would be your 3 takeaways from listening to me today. I think the first one would be updating or having job descriptions and making sure they are passing that duties test, that more than 50% of their time is being, them doing that executive or administrative work, making sure those job descriptions work hand in hand with those duties. The second, I think, is we have to start running the calculations, start running the numbers. Okay, how is this going to impact my business, right? Then once we get an idea for how this is going to impact your business and what are the options we have, I know it's December 1st is kind of around the corner, but we also have some time to see how this is going to impact your restaurant, the service of your restaurant, and what you can do. You have time to hire that next person if you need to. Now, I know finding people is always difficult, but at least we have some time to get ahead of it, so those 5 extra hours of somebody that we move to hourly can, in theory, be made up at a much smaller rate to lower your impact and mitigate some of your costs. So that's really the 3 things. 1, update job descriptions. 2, let's do the calculations and see what works best. And 3, does that work in my restaurants? And can I make that happen in my restaurants to get the impact that I want? So they're kind of the 3 takeaways that I would stress that you all kind of consider today. So I have some questions that I want to answer. So here's a question: if we have a manager that is hourly that is called at home, how do we compensate for that? It's a great question, right? So there is no rule, right, when it comes to how do you track this time. It's just you have to be consistent. As long as you have the documentation, you're good to go. For some of your employees, it's going to take some training to make sure that they understand that they need to now track their time. They need to, if they're getting called and they have to do a 30-minute conversation, that they have to, either add it to their punch-in, or they can, send a form. You're going to have to work a little bit on what that process is for your organization, but you are going to have to retrain some of these people to start putting in some of that time. All right. I have one: if they're hired to work at 45 hours a week, you should, right? If they're worked to, see, on all my scenarios, I'm doing the 40 hours, but there are ways you can say, yeah, your average rate will be 45, your average work week will be 45, and you kind of have to do kind of a backwards calculation. I don't really want to get into it on this one. I would love to talk to you about how we can make that work and what that calculation looks like. But yeah, there are ways, like I said, that you can kind of work around it or increase things to kind of mitigate some of those costs as well. And then the last question I have is, where does an owner-operator fall in this when they may draw a salary that is below this threshold? This is for salaried people. Draw does not count as salary. But that's a great question. If you're underneath that, how do you fall in? I mean, it's a great question, but I'd love to take that offline with you. But I will argue that I don't think that the DOL is going to be upset if you can't pay yourself. They're really looking for your employees and what you're doing right for your employees in those situations. So I don't think I answered your question. That's, I think that you have to work with your advisor, your lawyer on that one. It's a little bit of a more difficult situation. I think I don't have any other questions. If anyone has any questions, I would love to answer them, but if there's no more questions, I think I'm good today. Please feel free to reach out to me if you have any questions regarding these. I would love to, everyone's situation is so different that, we'd have to talk a little bit offline to kind of get down how it's going to impact you. So I appreciate your time, and have a wonderful weekend if I don't talk to you.